tutorial session. So we're going to look at a few things today. Let me show you. I'm getting more. Actually, let me bring up attendees here and see if you guys have any concerns. This is my best way of finding out about the banana peels that are typically strewn in the way, whatever I'm trying to do, certainly with all my devices and PCs and laptops. But okay, so you guys have nothing to say, so I'm assuming you can hear the sound of my voice. Just give me a show of hands on that. Good, good, good. Okay, that's good. All right, so I did mention tradeexchange.com, and I think probably some of you will have seen the presentation that I did last week. It was done jointly with RixPix and Trade Exchange, and the idea was to familiarize RixPix subscribers with some of the features of this platform. And let me show you, well, let me take that off camera for a second, but I want to show you just where things stand right now. It's still a work in progress, and here is the I would call this experimental really, but you can see that I have 3 different categories of trades that I'm going to be putting out: RixPix Bold, RixPix Stocks and ETFs, and Light. And you can see we've got small profits. We made a little profit today in a trade that went against the trend, and we got out of that. But you can see small profits, but in the RixPix Stocks and ETFs category, there's an egregious loss there. So I wouldn't worry too much about that. As I said, we're just trying to work as a threesome here, coming up with good trades, but also to work with, at this point, some of the limitations of the platform itself. The only type of entry we can use is a limit bid, and that winds up being somewhat limiting of our trading options. So we're working on it, but I wouldn't hesitate if you guys sign up for the service to jump in and take some of these trades that we're doing. You don't pay for the idea if it doesn't make money. Of course, if it doesn't make money, there's the possibility that it's lost money, and that's never good. But in any case, I think you guys who have been with RixPix for long enough know that we're simply going to produce. But again, there are a couple bugs to get worked out of it. Today, the only thing we've got on tap, we just put in a bid down here for DIA, currently trading at 266, meaning the Dow itself is at 26,600. So I'm looking for at least about a 400-point drop from here before this market turns around. Let me show you. We have, let's see here. I got a couple things. If you look at a big chart, I'm almost certain that let me spread this out a little bit. I'm just looking at it and thinking it's definitely, we're down here. I think it's definitely going to take out that low, because that's the way Mr. Market works. He wants to scare the pants out of everybody, off everybody. And so there's no way this support's going to hold. It's going to break just because there are too many people who are shocked, fearful, and appalled right now. So I give it 100% chance that low is going to get taken out. So the question is, when it takes out that low, it'll be shaking out a lot of bulls, and it'll be ripe for a turnaround. So where do we put the bid in? And as it happens, let me show it to you on another chart here. Let me get rid of this thing, which is going off in my ear. All right, get lost. All right. And let's go back to DIA, but not on my trading screen. I want to show you here. All right, so we'll go to, all right, so I want this thing to break down below that low, and we could do it at that point, just on a slight breakdown, as the old style counterintuitive trade, meaning we go A, B, with the C there, either slightly above, equal to, or slightly below that point A low right there. And then we just do A, B, C, and any rally, 25% of A, B will trigger us in for the long. But, you know, the adaptation we've been using consistently more and more is to shorten the interval there, and instead of taking the big AB, to use a reverse ABC pattern, meaning A, B, C. And that shorter interval AB will give you less entry risk. Strictly speaking, though, if we're doing the RABC, well, no, that's all right. I was going to make a remark about whether it breaks. It's important whether it breaks this low or not. I'm not treating that any longer as particularly significant. When it comes down here, I'm not basing my trade on, you know, the statement, well, I need it to break below that low. I think in this case, yeah, I really do feel like it's going to break the low, but we need to be prepared for other things to happen because, as you know, the counterintuitive trade really works off the fear factor. And believe me, we got enough fear right here that it doesn't necessarily have to break that low to bring the fear to a panicky crescendo. So the trade, you know, it could happen in any way, but I don't think we'll lose much. You know, we want a big enough AB so that, you know, if we take a really teeny tiny A, B, C, then our trigger is a rally that's equal to only 25% of this little AB here. And that's going to create risk of our getting stopped out of the trade. You know, we're being sort of half right. We do get a big rally, but before we get it, it rallies a little bit, makes another even scarier low, and then the second or even the third time's the charm. So there's more chance of our getting stopped out a couple times like that if we're using a really small AB. So if we use instead a larger A, B, C, let me show it to you. All right, the interval between the green line where we get in and the red line where we take profits is bigger, but we're sort of getting in when we're really more sure that this rally is going to happen, that it really is reversing. But of course, the price we pay for that is that the risk is bigger. You know, if we were using the smaller interval AB, this one right here, then yeah, we've cut the risk down there to about $160 per round lot. And in this case, with this vehicle, the trade that we put in with Trade Exchange is not 200 shares. We basically went for 10% of our 50, I think it's $100,000 trading account, which means we're only going to buy about 20 shares there. So we're not exactly taking huge risk. All right. So when it breaks down below here, how do I know how do I find an ideal place to actually do the trade? And in order to do that, I come down to the 60 like this, and we find this is a lovely BC, single bar A, and just by a zillionth of a micron, single bar B. So the pattern I'm looking at is right here. And I'm buying, I'm simply buying down here with the really tight stop loss. And the reason, you'll see when you sign up for Trade Exchange that the reason is there. You'll be able to read it. And it said, the reason I've given is catching falling piano, but with the safety net. So the safety net is simply we're using a tight stop loss. And for some reason, I think my buy point, I can't remember. I think this is the pattern that I used, but it could be that one right there. No, actually, my buy is lower than that. All right. So I'm just buying the D target with a tight stop loss down there. And we know one of the nice things about being able to put a bid in the void, and let me show you the void again, just so you remember. The void is in here. Once it breaks below this low, we're in uncharted water. So if we use a pretty tight stop loss there, it's not the same as if we're getting in and we stop it just below this low, or we get in down here and stop it below that low, because doing that subjects us to the cost clutter of idiots, imbeciles, village imbeciles, droolers that we hope to avoid. They're all using those lows as structural supports, and anything below that's going to stop them out. So, but if we're trying to buy somewhere in a void between those two lows, we're not going to have problems exiting with the stop loss. We'll probably get out, if this close to what the theoretical stop loss is. So if we're stopping it, I think at 18 cents or something. So we're risking maybe not much on 20 shares, obviously, but one of the reasons that I'm doing the trade, even though we're not looking for a lot of money, and I posted it as a possible day trade, but one of the reasons I'm doing it is because I kind of like buying the D pivot, the D target down there, the one that showed up on the 60-minute chart, and it's anybody who's paying attention is going to be pretty impressed, even though it's not going to make a lot of money. It's one of those cheap parlor trades that I refer to so often in the chat room. So yeah, I'm doing a little bit of showboating here, just to make the point that we've got some pretty good chops here for finding a turning point, and that on a day when the market's going to be down 1,100 or so points when we get down to my buy point, and I would warrant that the hidden pivot method is one of the very few that can make money on a long trade. On a day when the Dow has fallen 1,100 points. People look at you like you're crazy. You mean you say you actually made money today on a bullish trade? But yes, the hidden pivot method can do that, I think, better than any method on the planet. I think it does it better than, I don't think you can beat it, really. So, but as I said, we do have a limit right now on how to get short, and one of the problems we're encountering for purposes of building a good profitable record with Trade Exchange is that it's possible the market has made a major change right here. We could be in a bear market. So all of the tricks that have worked in the past, the mechanical trade in particular, we can't do that. And the couple of trades we're in, let's see, I think this was one of the symbols, and no, let me just check that again. All right, positions. All right, we've got a couple positions on. Let me show them to you, DT and AFA, and they're both getting crushed. But when I talked with my partners this morning, let me remember those symbols, DT and AFA. When I talked to my partners about them this morning, I have to say, like here, the trade in DT, it's all pretty good, really. It is a great impulse leg, and we had a good corrective phase here with final upthrust to the sweet spot. So here it's come down to the green line, and that's really where we buy it if everything, being according to the rules, and we put the stop loss below C. So we got almost stopped out there. Another few pennies and this trade would have been history. So we were looking at it, and it was just starting to rally, and there's a tendency to think, oh, we're getting killed already. Do we need to get killed some more? But we decided to just hold it, really, because it follows our rules. And of course, we've seen a lot of trades where it did take us right to the limit before it finally turned around. So even though I do expect the Dow to come down 1,100, another 300 or 400 points today, which means this thing is almost certainly going to stop us out below the line. In this case, I am simply sticking with my discipline. That's all. I've got feelings, pretty strong feelings about what the market's going to do today, but this is everything we want really. So I'm just sticking with the trade, and let's take a look at the other one here. It's AFA. All right, and I can't remember what our trade station is crap, so I've got to go off that symbol and return to it to get the times ungrayed out. All right, so here, let's see, look at a bigger picture. So I'm trying to remember how we got into that. Well, it's not as clear as DT, and we've got a big pattern here. Let me see how it goes. All right, well, I'm not going to belabor this because I'm not recalling the details. There are a lot of ways that you could get into trades here using patterns. This one, A, B, C, or the much bigger one, A, B, C. But we're long this. But the DT was a much better example, really, of how even when your rational brain is thinking we're going to get, we're just going to get crushed here. I'm just sticking with the trade because, as you know, the best trades really don't come from your rational brain. They come from that side of your brain that said, screw it, this thing that I'm looking at, this chart, is a complete deception. It's everybody. By its very nature, everybody sort of trading, trying to second guess everybody else, produces charts that scare the hell out of everybody. If it were otherwise, everybody would be a millionaire from trading. So the best trades wind up being right in the fear zone. You want to look at a chart and think you'd have to be crazy to get in here, or in the case of DT, you'd have to be crazy to stick with this trade, especially if you think that the Dow's going to come down another 300 points today. So, but I'm just doing it, sticking with the discipline, because the discipline overrides my instincts, which have a natural tendency to be scared to death of these charts, like everybody else. Or in this case, not so much scared of the charts as scared of my kind of subjective take on the market today. Okay, so let's look at a couple vehicles, that we might use to go against the trend. And it's interesting, I've got 7 people in the room here, which I think that nobody out there, you guys obviously do know the importance of these Wednesday sessions and just how much we get done, how much we learn really, and that includes me. I'm learning as well when I look at some of these things. And but anybody who's not in here, I think is foolish, really. I mean, if they've troubled themselves to take the flagship course or the mechanical course, even which is a mechanical course, comes with, I think, entry to 2 months worth of these sessions. If you sign up for the flagship course, I believe you get at least 6 months. I think maybe 6 months. But these sessions are really invaluable. I mean, they are really what will make the difference between just kind of being a dabbler and making money consistently. So I'm not sure where everybody is, but I applaud you guys for having a good sense to come to these sessions and to pay attention. And the people in the room really are people who have been coming to them forever. I did raise the price of them considerably because that's what they're worth. I just felt that if I gave it away, and it did get included in one of those cut rate packages that I've completely jettisoned. You know, my new marketing firm is not out there with it. If you buy now, you'll get this, 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 and that. I more or less reprice things according to what I really think they're worth. So and so these sessions, the price used to be just negligible because it was included in the cost of the course. I offered $997, gets you the full course and a year's worth of Wednesday tutorials, but I don't do that anymore. I think that we're sort of dialed in on something that's so valuable that I'm just not going to wholesale it anymore. And the people who come to these Wednesday sessions know damn well that they're worth every bit of the $200 a quarter or whatever it is that you pay for them. All right, so let's take a look at some vehicles that we might use to trade the negatives. One I looked at with my partners this morning that one of them had considered the other day was TZA, which is a 3X bear for the small caps. And those of you who are in the Russell puts know that this trade has been a winner. Let's see, 153. Yeah, so and it looks like anybody who bought the puts, even for as much as what was the most paid for them was 16, but I think that traders did get into them for as cheap as, it was like 7 or 8 cents. But let's take a look. I'm sort of curious myself, so let's go over to my TradeStation. Hang on here, get rid of this and bring this over. All right, so we'll do single option, and it was the November. Let me just make sure I get this right. Just pardon me for all right, so we're in the, let's see, it was November 6, 130 put. So let's take a look. All right, so here are the puts, and virtually everybody who got in them doubled the money. The ones who got in on these lows, and we did have some bidders that went as low as here. The lowest price was 7 cents. So I don't know that anybody would have actually bought that low, but certainly if you had a bid in at 8 cents, you had it. So some people have already quadrupled their money on these puts, and they did it all for a day. You know, when we buy these, I like to be really tight on the expiration. And here, all I wanted was any expiration that took me beyond the election. So today, everybody's getting paid off. They opened today at 19 cents, which would have made anybody that got in for 8 or 9 cents a doubler. But those of you who got in, and I think there was only one guy, but the worst price anyone reported was 16 cents. I did them for a dime myself and 12 cents, but I took 16, as is my custom, to take the worst report from a subscriber as the official price. So taking that worst price, everybody has doubled, because the high today has been 33, so that if you had them offered at 32, you got done on the trade. All right, so and that's what we always try to do. It's amazing how nicely it works. A lot of times when you go for that doubler, it so often winds up being some fleeting high. Like, I don't know why it's true, but when you go for that doubler, you tend to get out on the high of the day. But at this point, it doesn't matter. We've just got half of the position left at no cost. And some guys have, as I said, they have even quadruplers here. So that's good money. the timing was good, everything was good, and the thinking behind it was good too. The idea that we should have just a little bit of insurance in case the stock market sniffs a Biden win. God forbid that happens. But at this point, I have to confess that I'm still somewhat rationalizing my own logic from earlier. I said earlier, and I made this emphatically clear, that that the market is it knows better who's going to win this election than these imbecile, politically compromised guys who do the pollsters. All right. But I have to say that the market over the last couple of days has come down hard enough that I have to think about that. I have to deal with the question, is the market getting hit so savagely here? Because it really does sniff a Biden win. So you may think that I'm just hanging on to a slender thread here, but the way I've rationalized that is that the sell-off here is a very knowledgeable one. It's being engineered by the usual scumballs, the masters of the universe, because they really do think Trump's going to win, but because everybody else, all the imbeciles out there, the sheeple and the flock, the mindless herd, as long as they're capable of being stampeded into giving bargains, into handing bargains to the smart money, that's what the smart money is going to do. So I'm still going on that theory that we're getting hit really hard here because the smart guys know Trump's going to win, and as long as they've got the opportunity to shake out all the fools, they're going to do it. So that's what I think is going on. All right, so to come back to the TZA chart, TZA is just one of those vehicles that we could trade as get a multiple. I've always been skeptical of them, certainly the option side of these 2X and 3X things, because that's really just a carnival midway come on. The 2X and 3X makes you think, oh, geez, I can make like real money here if I'm even half right. But the fact is, you have to be 110% right just to barely break even on that trade, because trust me on this, the options in TZA are very knowledgeably priced. They are, you may think, oh, nobody's really thinking the market could collapse over the next couple of weeks. But not only are they thinking it, but they're charging accordingly in the risk insurance business here, the options business. So it's really hard to get with the options to make money here, but not so in the vehicle itself. Now, one of my partners this morning made the point. He said, well, he's found with the 2X and 3X vehicles, they tend to just kind of take off. And that happens to be true in this case that you're looking at right here. There's no way I could have, there's no hidden pivot rationale for being in this trade yesterday. It didn't even get above the red line or to the red line, where a pullback to the green would have at least given me a technical reason for saying I'll do the trade. It's a decent mechanical buy, really powerful impulse leg. But as things stand, we simply weren't in it. The only way I could have been in it would be to have thought, when I looked at the market coming down yesterday, to think it ain't over. This thing's it's going to come down the second day. And so certainly in retrospect, just being long this TZA a little bit yesterday was, it was I'm going to use an expression other than easy as shooting fish in a barrel, but it was almost a no-brainer. But again, I'm not doing the instinctual trades here. I'm really just kind of trying to adhere to the discipline of my method, which for all intents and purposes, as it connects up with TradeExchange.com, is to follow my discipline. So there would have been very little discipline in taking a flyer on yesterday's close and thinking, hell, I just want to be short overnight here. And even before the market opened today at 9:30, you might have had your doubts. I think they had the Dow down 500 or 600 points at the overnight, that the Dow futures, mini Dow, and we've seen it so much that it's down, but that's really, it's down to the point where they've simply shaken out all of the overnight sellers. They depleted sellers, and of course the technique that the scumballs use is to simply, they know when the overnight selling is dried up, that they're at the bottom, and the first thing in the morning, the first thing they can do is just take it up. They're just, the sellers are depleted. So, that's a very big advantage of having the book. So what we saw was that there was still an onslaught of selling in the beginning, in the opening bar, but then they did manage to rally this hope for the next 15 minutes or so. And, there was every reason to think that this is like everything was a month, 2 months, 3 months ago. And for most of the 9 years or 10 years of the bull market, it is, you got to buy the dips. But in this case, the dip is dangerous. And point of emphasis with my discussion with my partners this morning was, we need to be sensitive to that. We need it's acutely difficult to be making money with one thing and it just works, and it's been working for 9 years, other than on March, a few months in March, it's just worked, buy the dips. But so you develop a kind of mindset over months and years, and to sort of be right on top of the tone change where it's not working anymore, we're in a bear market, we have to be sensitive to that. So again, not to make excuses, but that in part accounts for this this $2,100 loss here that is out of joint with the small gains and the other stuff. So again, we've got a learning curve, and I hope that my competitors, other gurus that you guys could sign up with if you want, are caught even more off guard than we were. But for sure, whatever gurus or algos or anybody have been doing trading wise over most of the last 10 or 11 years, is we're in a different, we're not in Kansas anymore. So anything that's worked very steadily is going to come up against a change in market conditions that will make probably most of these systems not work. And one of the nice advantages of the hidden pivot method is that it's just subjective enough that we can make adjustments relatively easy. We can say that that when we do the mechanical trade, we want a longer BC pullback, before we need more, we want it closer to the sweet spot. We want really ideal trades before we do them. So those are very easy adjustments to make. But to take a really sophisticated algorithm, and the more sophisticated they are, the more difficult it is to make the adjustment, to tweak its performance level back to the original. That's really hard. And I know that, I mentioned this before, that a friend of mine that I've done a lot of business with in the past, Mike Barna, he's arguably the best trading system developer on Earth. Trading System Labs is his Trading System Lab is his website. But Mike, I think he is in the top 5 trading system guys in the world. So when we were looking at ways to automate my system, and this was before I got down to some very, I took a lot of the subjectivity out of the trade. The old method of simply finding perfect patterns and trading against D target trend targets. It took a lot of skill and a lot of nuance in discriminating out the best patterns. And Mike looked at it. He kind of worked at it for a month, and he came back to me and he said, I think you're going to do better just sort of capturing these trades by hand, so to speak. We can't. It's very difficult to take some of the concepts you're using to trade and express them algorithmically to create a rules-based system, because my rules were a little bit squishy, and that's much less so really now. But he did say at the time, he said, virtually all trading algorithms degrade over time. The performance always weakens. And he said that it's a really thorny project, even for a trading system genius, to take an algorithm that has whose performance has somewhat fallen down and tweak it back up to its original level. So he uses white box systems, which somewhat negate that problem. His Mike is working in the area of genetic algorithm generators. They essentially create systems on the fly based on whatever parameters you feed into it. But it requires huge numbers crunching capacity. But he's the algorithms are constantly not so much adjusting themselves as being reborn. Okay, so let's get back to some of these vehicles that we can trade, and which I may find myself having to trade simply because, as of yet, Trade Exchange does not have the capability of shorting things. So you need to trade vehicles that have a short, that's intrinsically what they are. They're short positions on this or that. And one other problem that my partners and I will have to work around is that at least as of yet, there's no partial profit-taking ability in their platform. If we get in on 400 shares, we don't have the option of exiting 200 shares when we have a small profit in it. And those of you who've been with Rick's Picks for a while know that that's really the heart of my trading system. That is the way I trade. I like to always take some money off the table early on. And I've had a couple of trades where, I've had a great partial profit-taking opportunity, but I couldn't do it. In fact, with one particular vehicle, I got a ride of about 1.5 points, and I was a half a point off my target. And I'm thinking, well, I'll take it all off there, but it slid back against me. And then at the end of the day, it closed a little bit up, and then the next day it gapped down, and I wound up with I took a loss in it. So there'll be definitely a lot of adjusting to do here, kind of modifying my system so that it goes more, so that it can handle the limitations of TradeExchange.com. That is not your problem, even as to the profitability of it. That's my problem to resolve. You don't have to do trades, and there may be gurus out there who they just do the trade and they don't worry quite as much about risk reward as I do. It would be my contention that over time I will outperform them. But I have to say there are times when I'm somewhat envious of guys who just put out a trade and they get in at 42 and they're shooting for 55 and it goes against them, 4 points, and they just sort of sit on it. And I've always felt that's no way to trade, really. And I've probably gone to the extreme opposite direction. I'm so obsessed with every penny of risk that it does kind of constrain me sometimes from doing certain trades that at the instinctual level I like. But I don't think there's anyone out there in the trading world that controls more tightly for entry risk than I do, and for that matter, who controls more tightly for managing the ongoing risk of the trade. So I'm as risk averse as any trader out there, man or machine. And sometimes, as I'm implying, I think over the long run, it's always going to be an advantage. The trade-off being it's work. To manage risk in a very particularized, the obsessive way that I do, it just takes work. And I do admire and envy some of those guys who stay in that trade at 42. They let it go down to 36, and it'll come back, and eventually it does. But even a few of those guys are in for a rude awakening, because a lot of them sort of develop that sense of a trade over the course of a bull market. And it's true for most stocks that if you get in and wait long enough, you'll make money. So in that context, the huge pullback that a lot of these yo-yos subject their subscribers to are, it's crazy, but a bull market has bailed them all out. Not so with options. Anybody who's out there, trading direction and taking advantage of the bull market has not made money with options, at least not easily. And anything you read, any promotion that says, we've figured options out and here's how we're going to do it, they're frauds. They really are frauds. The only systems that work with options are similar to the one that Ira Tunick taught subscribers. And I may put that out there for subscribers, because Ira made some recordings of his lessons. But it was very labor intensive. He essentially took the chart and he plotted standard deviation curves and matched them against the option premium, so that when he went into a trade, a lot of times it was a spread trade, and almost all the time it was, he could calculate on the basis of standard devs just what his odds were of making money. But the money he was trying to make was a relatively small amount. It was very work intensive, and he had to adjust constantly. When things moved his way, he had to adjust these. So that is the only way, or if someone's out there advertising consistent profits in options trades, that's what they're doing. They're essentially measuring the options premiums against standard deviation and calculating what the odds are that the stock will be inside of the range, or maybe even outside of the range at expiration. And the same thing was true for a while. I was working with a guy who wanted to access my subscriber list, and he had his own service, and it was expensive. It was, if I recall correctly, it was several $1,000s a month. And I think he was pretty good, but we never really worked it out. I mean, we couldn't come together on. He was constantly changing his price, and it just didn't work out. But again, he had figured options out, but not in a way that could allow him to say it's easy. Look here, it's as simple as pie. Well, that's why you pay him $3,000 a month. Although he wasn't doing the trades, he was giving you all of the adjustments that needed to be made, and trust me, they were work intensive. All right, let's see if we can maybe trade against gold and silver. They're getting hammered so badly, and I did get on top of this when it started. This idea that gold and silver have become so exquisitely sensitive to the dollar that they no longer go against the dollar, only pennies really. And we can just look up here and see the dollar index is up 50 cents. And no, we don't even have to look at gold and silver to know that they're getting slammed. So, but let's see if there's a bottom in gold that we might avail ourselves of. And those of you who have followed gold and silver and RIXPIX know that I've been on the right side of it kind of forever. And even when I'm skeptical and it goes and it rallies, I typically stay skeptical. And I've only been wrong maybe a couple times in the last 7, 8, 10 years taking that approach. You know, I might be 1 or 2 days behind a move, but certainly no more than that. So I think that skepticism is definitely justified right now. And if you read the tout, I just wasn't getting too engaged in the uptrend, and that's particularly true for the touts that I put out for GDX, which is, to me, it's crap. It's I just got so tired of it so long ago that I don't even pretend to try to make money for subscribers using that vehicle. All right, so let's take a look here. And it's all bullish relative to back here, you know, but and arguably, all right, so the impulse leg that we're using, it's becoming more and more clear here, or it's been clear for a while, but it's right here. Single bar 1 off A, single bar B, got past major to very nicely etched external. So there's no doubt at all about this pattern. And I haven't looked at it really, which I should have, given that I'm looking at it now and seeing how absolutely clear it is. But let's take a look and see where this leaves us. If TradeStation stops sucking for about 6 seconds, okay, there we go. All right, so we'll come down here for the low. And the bullish idea, well, we had a clear pattern and an absolutely clear target. And when you miss the target down there, as this is done, and it starts to rally, you have a subjective presumption that it's bullish, that it didn't quite reach the D target, because overall it's bullish, and it didn't reach it because the larger uptrend, meaning this one here, A, B, C, prevented it from having a fully developed ABCD downtrend that reaches its D target. And that, as some of you will remember, maybe all of you, is a key feature of the hidden pivot method, that really good, strong trends, the dominant trends that are bull markets, produce counter trends A, B, C that do not reach their D targets. So when we're down here, we don't know that it hasn't reached the D target yet, but when it starts to rally a little bit, we're able to say, still subjectively, that, well, it just never reached D. But to negate the target itself, as you guys remember or know, would require a move above C to negate the pattern itself. So in other words, we could have even gotten closer to the target there, and it still would have been valid as long as the C of the pattern is intact. So that may be what we're seeing right now, is that it's finally getting to the target that has been valid all along. However, as spooky as it is today, we have the same trade that I was trying to explain earlier in the diamonds, and that is, once it breaks below this low here, this is a key low on the chart, at least for this bullish part of the pattern. And it wasn't a good sign. You know, we have a, let me spread this out for you a little bit. All right, so we have, here's the impulse leg, A, and this is a really important point that I will make every time I get an opportunity to do it. Here, even with all this chop garbage here, we have a reasonable visual frame of reference for calling this thing right here, you know, it's a good impulse leg. Good, that's a good ABC. All right, so, and the whole reason for being able to call it a good ABC is that when we got to that first, did this part of it, A, B, C, did that end it all? And then the next leg up was just a failure? Well, it would have, except for the fact that our new high actually got past an additional external peak right there, refreshing the impulsiveness of this rally. All right, so that very subtle factor gives me the ability to label everything from there to there as one unbroken, like all this crap didn't even happen, straight shot impulse leg. It's a good one, all right, just because that last little piece of that uptrend did manage to get past an external peak. All right, so everything's in place now. We've got an A, B, C pattern, triggers a theoretical buy at X, and really it delivers a profit there and more profit there, but it never got quite back to D. So when it came back down again, the question becomes, can we use this as a pattern? You piece of crap. Hang on one second. All right. I was talking figuratively of TradeStation there. It is a headache to use in the way that I use it. All right, so here's our pattern, and can we adjust it in this way? This is our new point C, and there's our new point B. And the answer to that question is no, because this little piece of the rally didn't take out anything to the left. It didn't refresh the impulsiveness of this leg. So you've seen this before, where I took something totally from outer space here, a totally gnarly AB leg with all this chop like that and a huge swoon down. And I got a point B up there and I said, yeah, that's it. That's a straight shot, A, B, all of this crap didn't even happen. Well, I do that simply because the last piece of it, the last gasp high, actually got past an external. It didn't here. So this isn't even an impulse leg, and which means that the failure of the would-be beginning of a new bull market, or the resumption of the bull market that we would like to think had begun at that low, really didn't begin. It was simply a rally, an ABC pattern, this one, that failed to reach its D target. And much as we wanted to believe, hey, the deal is on again with this horribly choppy rally, it just wasn't. From the failure of this and the point where we start making impulse legs coming down, and I don't think we did here. Let's see if this low took out this by a millionth of an inch, and that's all we need. Let's see. That TradeStation, you garbage. All right, I say that because if I'm trying to move something and my cursor is light years away from what I don't want to move, it moves it anyway. It sort of grabs this whole pattern and shifts it. All right, so let's see. The low there is 85.3 versus 8. All right, so this actually is an impulse leg, because that low here exceeded that low by 10 zillionth of a micron. And that's all we need. That's everybody else on earth calls this a double bottom. I don't. I say that the beginning of trouble was when this A, B, C, D failed to reach its D target, and it becomes officially and technically a problem when we start making impulse legs on the way down, as we did here. So from this point forward, your point of emphasis should not have been the bullish pattern originating down here, or even here, A, B, C, but we should start essentially favoring the bearish pattern, which is right here, 1 off A, and we know that low is a zillionth of an angstrom. Right, so this became our point of, this is the pattern we should have favored. And I don't even know the extent to which I did that in my touts. I'm giving you guys an analysis that maybe goes a little deeper than anything that I had reasoned in the context of the touts. And So I think this little hunk of burning love is coming down to, well, all right, we'll see. We'll see at the midpoint because we've got a double midpoint here. Well, forget about the big one, the pink line, but we have a, well, let me see. I need to eliminate some of the stuff here. All right, so you can see the clarity here. And unfortunately for bulls, the absolute precision of the bounce from P. So that confirms my choice of A's. I could have used that as a one-off, but because from that one-off to down here, it took out something there. It actually exceeded a low. So I start fresh here with an A high producing a downtrend that doesn't take out any lows till here. So that's a subtle point that I can't ever really remember making. But in this case, you guys might have thought, well, how about using that as your A? And I don't use it because its first attempt to go down was aborted after it had taken out that external. All right, so this is really subtle. So to come to that is our one-off A, and that is our B, because we know that that B exceeded that one, that low there by 10 zillionth of an inch. We've got a C that's all by itself. So this is as gnarly as patterns get, and you better believe I would have been down there if I looked at it just with a spec buy there. But the bad news for bears is that we've really crushed the P midpoint today. We didn't gap through it in a way that would make me say there's a 110% chance that this thing's going to fall to D. But I would say that it's come through P with enough force that it really is going to fall to D. And not only that, but as you know, when we have an exact bounce from P as we did here, we've got an exact target to use at D. It's going to turn, not only is it going to get to 1827.60, but it's going to turn there with absolute precision. So we can do the trade two ways. Then we can do it the old way, put a bin in at 828.10 maybe, and a stop loss at, this is really a big stop loss compared to what I think is needed here, but we put the stop loss at 825.9. All right, just below the whole number that's below where we're actually buying. So those are two ways to do the trade, and I would encourage you guys to do that trade to make up whatever, if you've been a subscriber for 10 years, this trade will make you back your subscription money. So all right, I think we've covered, interestingly, some old material, some old concepts, but with applicability here that it gives you the ability to tighten down a bit on some of these trades to really to get them very precisely. And I would strongly encourage you really to do that trade down there. But I think it's just it's neat the way I was able to look at. I had an opportunity to look at some things that are sort of ancient hidden pivot method and find a couple things about them that are relevant to anything we might do, even in the way of mechanical trades or RABCs. So, all right, so that's about it. Gold's actually having quite a rally here. I wouldn't trust it too much because the dollar is not having a corresponding decline. So that's everything for today. And as is my custom, I'm going to take questions from you guys. John wants to look at NQZ, so let's have a look. All right, well, this is it's a mechanical buy. We've had a great impulse leg, I mean, you almost have to buy this. I'll tell you what the risk is, though. I mean, in terms of dollar risk, this is a monster trade. I'm not going to do it with a straight buy at P, but I have to say that it's going to work. It will work. The beauty of this pattern, of this opportunity, really it negates the fear factor. I mean, we have to realize that the mechanical trade kind of thrives on fear. It just works. In this case, it's not the sweet spot conventional textbook trade, a high here and a pullback to the green line. In this case, we got to the pink line, and just Mr. Market knows I'm out there, and that's why he does this little dog and pony show, bringing the high up there to within 10 zillionths of an inch of the secondary pivot. He knows that my system says, look, I want to see it hit the pink line before I buy the pullback mechanically. So that's why it stopped there. I hesitate to believe that there's anybody else out on the planet that was, I take that back. Maybe it is a 3/4 level on a pretty obvious ABC. So maybe that's why it didn't quite hit it. But I would think if that were the case, it would have not quite hit it by a bigger margin. All right. So to get to the meat of what my instruction wants to tell you here, and that is, it's not a conventional mechanical with the sweet spot high and a pullback to the green line. In this case, we got to P2, and we still know the same thing that we know in any mechanical trade, namely the impulse leg is so strong that once it's pulled back and corrected, but good once, that when it embarks on that CD leg, it's just going to get to D. There's just too much buying interest. It was very visible, very obvious right here, for even Mr. Market, scumball that he is, to shake everybody out. There's too much buying interest to get it down here. And you might argue, yeah, well, this time it's different. There is a lot of selling out there, and maybe this is the big tone change. But if you're not going to use the volitionless, the ability to do the mechanical trade and ignore your worst fears, then why even use it at all? So as much, I know I'm being a hypocrite here, but I'm saying this trade absolutely will work. I just can't see it. I guess I would say there's a 5% chance that it's going to come down here and stop it out. But this, strictly speaking, is a great mechanical trade, and you can do it with the Qs. Let's see if there's that's the way we could do it. I mean, if we want to do it on the cheap, we take the Qs, and we have the same trade here, almost identical. You can see that, and we make the bullish assumption. We say that, first of all, that, as I mentioned earlier, that the scumballs are simply shaking things down here because they have the ability to do it. They have enough people willing to believe that the Biden fear factor, that Biden's going to win and the market's going to get hit. So the masters of the universe are simply using that as an opportunity to shake the market down. So if that's correct, let's look at the target of this baby here. The target is way up there, 312, all right? But we know that if Trump wins and everything's right with the world, it's going to go to 312. So let's see what the 312 butterflies are looking like right now. Because this is outlandish. Most people aren't thinking of a rally to 312 right now. So let's see what kind of price we get on butterflies that are key to, we'll take it around 310, all right? So we'll go on my page, and we'll put up QQQ. And this is an exclusive, guys. I'm going to put this out in the chat room or in a tout as well, because it deserves to be there. This isn't all right. So we'll do the butterfly here, and let's see what the spread width is. I want to peg 310 as my. We're 2 points. We can go a little bigger here. We're thinking extravagantly. So we'll go for the 4. Let's see what 4 gives us. Let's see. All right, so it gives us 3-point intervals. So let's try 8. We're going to go spread width 8. And now, all right, so 310 strike, we're doing the 303, 310, 317. All right, so a spread width of 8 with this particular vehicle at this price gives you 7 points differential between each end and the middle. So that's not bad. We've got there a 14-point range, but the important thing is we're mainly focused on a target. We don't care. As long as it gets to 310, we're going to make a lot of money with the spread, even if it goes to 310 and it's on the way of overshooting it, going to 330, 350, whatever. As long as it goes up and passes through 310, we're going to have a great profit opportunity. Although it won't be the optimal, the maximum, what we could extract from the spread, it will be all right. So the 310 as a call spread, it's quoted 2 cents bid offered at 15. So that's a 13% differential. Half of that is 6 cents. So if we're in there bidding 8, 9, 10 cents, I think that's all right. And if it goes to 310, the spread will be worth $700. So we're looking to pay $80 for the spread. It's 80, 90, and it can go to 700. And we don't have to, we can shoot for lower if we try to leg it on or we're stingy on a bid. Let's say we bid 5 cents, 50 bucks. No, wait, I'm sorry. Let me, $50. Then, and it can go to $700. That greatly increases our odds. We're getting close to 15 to 1 on that. So I don't think that's a bad bet at all. It's not a terrible bet even for 8 cents. So I'm going to put that spread out there, but you guys are the first to hear about it. And if you have any questions about these butterflies, you should check out the video lesson that I put out there that really gets into it. So if you want to leg it on, you want to be buying 303 calls, and let's see what they're selling for right now. Oh, I'm sorry. What? You know what? I've got the wrong. No, this would be. I want to go out a little further. I want to give it more than, if we have a huge rally after the election, I want to give it at least 10 days. So if not a week longer, but let's go out a little bit longer, and this spread will be a little more costly. But all right, so it's 14 cents bid offered at 28. So I would say you could buy a few of those. Midway is 21 cents. So if you invest $80, you buy the spread, you bid it 4 times, 21 cents, $80. You have a chance to make on it $2,800 max. But realistically, instead, you're not going to get $7 for the butterfly. You get maybe 4. So you have the ability to make, in any case, on those 4 spreads, $1,600 for an $80 investment. So that's 20 to 1 odds. So that ain't bad either. But you get the idea. The key is we're pegging the 310 strike here, and that's good enough. And I'm going to play with this myself, and I will keep you guys apprised as to what actual prices I'm getting on this butterfly, because I'm going to be bidding it myself. And if I find that I can't, 21 cents is unrealistic, I'll either try to leg it on, and which means I buy the 303 calls first. Let's see what they sell for. All right, so the 303 calls are priced at, that ain't so, I mean, how bad is that really? Even if we're wrong, if we buy these things, let's say the Qs are coming down, 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 and we buy these for 48 cents or whatever, and there's a big spread there. I mean, these are way out of the money, and the options traders aren't giving them away. Anything could happen. So they're saying if you want jackpot odds, you're going to pay up for it right now. So, but it's a reasonably tight spread. And so you can see that even if you're wrong, the QQQ is coming down, down, down. You put a 48-cent bid in there for it, and it gets hit. It's like, how much can you lose? So I would say I would even favor trying to leg it on, with obviously a little more risk to doing it. But I bid these in conjunction with the D target bottom on the Qs of minor degree. So we can't get hurt too badly. And if it keeps going down, I might ride this a little bit and wait for some sort of rally that would allow me to sell the 310s for whatever I'm doing. So what happens is, and in practice, let me warn you. So if we're legging it on, and this is a point, I don't know, it's covered implicitly in my little recorded lesson. But if you're legging it on, look what happens. You're really doing two spreads. You buy, let's say, 4 of these for 50 cents a piece. Now, you guys, I'm sorry, you buy 4 of these for 50 cents a piece of 303s. All right, so in a butterfly, the 310 is the middle strike, so we're selling 2 of those. The problem with that is if you buy 4 of these and you sell 8 of these, your brokerage firm is going to consider you naked short 4 of them. So that has consequences. So what we need to do instead is we leg in, we buy these first, these 303s down at, let's say, 50 cents. And if we're right, we get the little rally, we sell 2 of these, but we buy one of the 317s at the same time. So we're initially we buy the 303s and we 4 of them, and when it rallies, we sell this spread 4 times. We sell 8 of these 310s and we buy 4 of these 317s. And in that case, you'll never be naked anything because these 317s are long. They'll cover the additional short 310 that you are getting into when you do the second piece of the spread. So that's I just wanted to get you guys a little bit, just one step ahead of the brokerage problem, the margin problem that you might not otherwise be aware of. So that is it. And I hope you make hay with that, really. And there's the diamond trade that I put out there today. You can take that or not for the reasons that I gave you. And I think it was a great session today. So thanks for joining me, and thanks for your rapt attention. Hang on, wait, before you go, I've got one more request for silver from Phil. Phil has been with us for about 107 years. He's been with Rick's Picks even longer than I have. Speaking of coming back or being with Rick's Picks, Farmer has come back from almost literally the dead. Those of you who've been with me for a while will remember Post by Farmer in a chat room. His real name is Cameron Fitzgerald, and he's done a lot of stuff. I mean, he was amazingly knowledgeable on the bee die-off because he's been a beekeeper. He's farmed in Nairobi and he's farmed in Canada. And you recall when he was in the chat room, at one point he was talking about incoming rocket fire grenades and things, because in the compound where he lived in Africa, it was one of those very dangerous places. He's been everywhere but Helmand province in Afghanistan. So he's really been around the block, and I'm looking forward to having him back in the chat room. He, when I last had email contact with him, this was more than a year ago, he had contracted a disease called aspergillosis. It's a disease of the lungs, and most of us don't get it. We just sort of breathe these spores, and our immune system disables them without any problem. But if your immune system is compromised, the aspergillosis can take deep root in the lungs and really screw you up. So he could barely breathe, and he was nearly dead. But he understood, even in that weakened state, that he was going to have to go somewhere besides Africa. That they couldn't. They have good hospitals there, but not quite up to his very grave condition. So I wrote him a couple emails, and I never heard from him, and I feared that he had died. And then out of the blue last week, I got an email from him. He was alive and in Saskatchewan, and he'd spent a year getting well. So he's almost completely recovered from this horrible problem. And you're going to be seeing him around. He's just a great source of information. He's very worldly. He just knows so much about so many things. So anyway, enjoy Farmer's company when he's in there, and you should be seeing him around soon. So that's about. Oh, so I'm sorry. So Phil wanted to look at silver. So let's take a look. And it's doing the same thing that gold did. And I hate to break the bad news to you, Phil, but it looks like we've got to reach up here for minimum downside. Let's see what the pattern makes. I wouldn't even stick with this small stuff. All right, so we're up here for A. If TradeStation would let me grab that A, we'd be up there. All right, we're coming down to at least P to 22.825, and I think it's definitely worth shooting there. You know, you could structure it as a really tight small interval AB reverse ABC trade like A, B, C. You're gonna have a buy down there, so definitely do it. You might even get away with a bigger AB like this one, A, B, C. It's going to give you more risk, but once you get triggered into the trade, you'll have more to shoot for getting to that to the red line for your minimum profit. So that's what's going on in silver. And of course, if it doesn't hold the red line, we could see prices below 20. So so that's silver. And I'm only the messenger. All right, so that's it for today. Great session, I felt. I hope you guys enjoyed it as much as I did. And I guess I'll see you in 2 weeks, and happy trading.